I have to finally call you out based on your comments that you made last week regarding your opinion on the stock market. You stated that you believe a stock market correction is coming based upon reversion to means and rising interest rates, and yet you are doing nothing because you don't need the money. I get it, time is your friend and ride out the waves. However, if you seriously believe that the market is overvalued and you are doing nothing, then you are speaking out of both sides of your mouth, and every dollar doesn't really matter to you. Many people listen to your show for financial advice, and most are probably not millionaires, so any advice you can provide on market timing is welcome advice. Imagine if Michael Burry, who predicted the housing crash, ignored the data and did nothing for his investors. I'm sure your response will be generic in nature, like slow and steady wins the race. Sorry, that advice is for the layman, not for those listening to financial podcasts. I still love and appreciate all you do, but if you also know who is going to win the Super Bowl next year, don't hold back. And that's from Doug.
Doug, thank you. My beloved Atlanta Falcons are not going to win the Super Bowl next year. I can guarantee that.
You cannot guarantee it.
Oh, I can.
No way.
I can. Salary cap issues. They lost Matt Ryan. I mean, it's not going to happen. Sorry. But you have become an Indianapolis Colts fan.
Well, yeah, I do love Matt Ryan. Boston College graduate.
Boston College. Okay. So you said, repeat that part that Doug said about don't do the lame thing of
saying slow and steady wins the race.
Okay. So I am lame. I really believe that for the typical person putting money in on a regular basis through a 401k, Roth IRA, whatever, that you just ride through the storms. Because if you look at the history of stock investing, the largest amount of gains happen in very few trading days. So to tell somebody, go to the sidelines and wait till the dust clears, till the bottom has been hit, we never know when that bottom is. I play the odds that over time, there are far more up years and up quarters of stock markets than there are down ones. So I'd much rather stay in the game and ride through the rough waters, because I don't know when rough waters become calm waters. And I think back to 2007 and 8 and into 9, when I kept trying and failing to get people to ride through the scary down market. People who rode it all the way down but stayed in ended up with this enormous boom that started in the spring of 2009 with stock investing and rode to huge gains through the teens or tens, that last decade we went through. And so if I had gone to the sidelines or advised you to, and you put your money off to the side, the problem is people don't know when it's safe, and you would have missed a lot of the gains that happened particularly early on after the market bottomed out in 2009. And I'm not predicting anything like that kind of collapse, but who knows? It can happen. I mean, part of investing is the cyclical thing where we have declines of the market of 10% or more, known as corrections, and then we have bear markets of 20% or more. I believe that dollar cost averaging is your ultimate friend. That's where you put money in steadily, well diversified, and you ride through the bad times so that you benefit from the good times.